Put 60% of your eggs in safe, tax-free baskets. In this episode, I'm going to address the question, how to diversify investments at retirement. Get ready. You're going to learn some things that most people do not consider, especially retirees, until it's too late. So my name's Doug Andrew, and I've been a retirement planning specialist for more than 4.5 decades. And during that time period, I've helped thousands of people prepare for a comfortable retirement to hopefully not outlive their money. And in doing that, I've helped many people reposition their assets that oftentimes they accumulated planning for retirement. And at retirement, what you maybe did for your retirement planning is not the same thing you should do at retirement. And so I'm going to show you how many times I would reposition their money, especially out of tax-deferred IRAs and 401ks, into something that was going to be far better. It was going to be tax-free and help them not outlive their money. And oftentimes I increase their net spendable income by double, triple, and even quadruple what they were getting from their IRAs and 401ks. And they would say, "Where have you been? I wish I could have corrected these mistakes years ago." Well, I don't want you to be kicking yourself because you didn't learn about this. So get ready. I'm going to share with you some of the basic places most retirees have money at retirement, and where I think they have too much in some of them, and how they have to reposition or rebalance their portfolio. So here we go. Here on the screen, I show 4 common incomes or accumulation buckets or vehicles that many people draw from during retirement. Now, some draw from 1, 2, some just 3, or maybe all 4 of these. But let me describe them first of all to you. So there's a lot of people that would come to me and they were way too top heavy in traditional IRAs and 401ks, yet to be taxed money in tax-deferred IRAs and 401ks invested in the market. And I would go, what are you thinking? You should have no more than 30% of your money in the market in yet to be taxed vehicles at retirement. And they went, wow, well, I know a lot of people that just keep their money in their IRAs or 401ks the rest of their life. Their CPA told them to do that. And I go, well, that CPA is very myopic, very short-sighted. That's not saving them tax in the long run. So let's look at these 4 different areas that people draw from in retirement. This purple area in this northwest quadrant would be investment income, yet to be taxed IRAs or 401ks invested in the market. Some people own real estate and they love the rental income that comes from the rental real estate properties. But many times at retirement, they're sort of sick and tired of being a landlord, but they're sort of stuck because they've been doing 1031 exchanges for years, going from the frying pan into the fire. And they're sort of sick and tired of taking out the trash and fixing toilets and evicting tenants, but they feel like they're stuck. And so they have their real estate income, but they're not happy. Then we have people who have a lot of money into investments that are very conservative because they have a very low risk tolerance. And so they have money in their pensions, profit sharing plans, maybe annuities, or maybe they're just relying on Social Security. That would be this southwestern quadrant. But over here, this is my favorite, and it's the most misunderstood and least utilized. It's what I call the tax-free income bucket. And you're going to see, I recommend that you have between 40 to 60% of your income in that one. It's not even showing up on your 1040 tax return. So let's dive a little bit deeper into each of these buckets, I call them, or baskets where people put their money. So again, this one up here is where so many people would come to me at retirement and they were way too top heavy in yet to be taxed IRAs or 401ks invested in the market. If you don't understand this, you need to learn sooner than later that Wall Street was never built or intended for you to sell or liquidate your stocks, your mutual funds. If you ask people on Wall Street, when is the best time to sell? They will say, Never. Never. Wall Street was never designed to be able to create predictable cash flow on the back end. It was designed to hopefully grow your money over time, even though it's like a person with a yo-yo, hopefully walking up some stairs where your money grows over time, even though it goes up and down in value because of the volatile stock market. But it was never designed to create predictable income streams, and that's why the financial services industry, if your money is in yet to be taxed IRAs or 401ks in the market, they usually recommend you take out no more than 4% a year. Now that's pretty pathetic. If you have $1 million nest egg, they only want you to pull out $40,000 a year. You'll have to pay tax on that. Even in a 25% bracket, you're only netting 3% or $30,000 a year. That's pretty ridiculous to me. In fact, it's unacceptable. And so you're gonna see here that I recommended many people do a strategic rollout out of here, that no more than 30% of your money should be in this bucket at retirement. But so many people, 80, 90, 100% of their money was in this one. The other category up here in the northeast quadrant is the real estate bucket. And it could be your home. You can do a reverse mortgage on your house and so forth. It could be rental properties. But like I said earlier, I've noticed a lot of people don't want to be a landlord anymore, and they're sort of stuck because they've been doing 1031 exchanges, delaying the inevitable, and now they're stuck because they wanted to leave that behind to their kids so their kids can inherit it without with a step up in basis on long-term capital gains. And it looks like tax revenuers are looking at doing away with the step up in basis on long-term capital gains. That's another subject. You can search this very channel to learn more about that. This blue bucket, many times people just don't want to manage the real estate. They hire a real estate manager, and you can't believe the horror stories that I've heard where these managers embezzle money and so forth, and people just throw up their arms. Well, I would recommend that no more than 30% of your money ought to be in the real estate bucket. Now, before I show you the last two buckets here, the other two quadrants, if this is already resonating with you, I would recommend that you share this video with somebody else who ought to hear this information. Subscribe to this channel, it's free, and click the little bell because you'll be notified every time I post a new educational video, which I do almost on a daily basis. But stay with me to the end, because I want to gift you a copy of my most recent 300-page best-selling book called The Laser Fund. And this will empower you on how to diversify and create the foundation for a tax-free retirement, which is the green bucket I'm going to get to here in just a moment. Now, the yellow or orange bucket here is what I call the guaranteed bucket. And I would recommend anywhere from 0% up to maybe 80% of your income could come out of this bucket, depending upon your risk tolerance. For the super conservative people, they just want to rely on Social Security or maybe their school teacher pension out of this bucket. Sometimes people will consider an annuity. I've never owned an annuity. I doubt I ever will. Annuities are okay. They're only tax deferred, and when you take out income, it's taxable, LIFO, last in, first out. Meaning if I put $500,000 into an annuity, and if I was earning 10%, that would be $50,000 a year of interest. If I pulled out the $50,000, it's 100% taxable because the last money I'm earning, the interest is the first money coming out. That's called LIFO tax treatment. And so this is usually only good for people who maybe don't care about being rich. They just want to be guaranteed they'll never be poor. And so you can get annuities that will guarantee you an income that will last as long as you do if you live to be 120. But the rates of return are not all that great in the long run. I can do far better over here in this bucket, which I call the tax-free bucket. So the green bucket is my favorite bucket. It's called the tax-free bucket. And there's generally 3 different types of vehicles in that bucket. One could be municipal bonds. Now, a lot of people are not buying municipal bonds because a lot of municipalities are filing bankruptcy. They're not as solid as they used to be, and they're low yielding. I've always earned in my laser funds, that's my tax-free bucket that I like to use, I've always earned rates of return 2 or 3 percentage points higher than municipal bonds at any given point in time. Now, a lot of times people think, well, a Roth would qualify there. Well, yeah, a Roth is a step in the right direction. I've never owned an IRA or 401k, never will, but I've never owned a Roth IRA or 401k, and I never will. I have episodes on this channel that talk about the laser fund has the 2 benefits that Roths have, plus 4 additional benefits that Roths will never have. Why would I own a Roth when I can have the benefits of a Roth and 4 additional benefits that knocks the socks off of a Roth IRA 401k? You can learn about that on this very channel. But my favorite vehicle over here is what I call an MFTA, Max Funded Tax Advantaged Insurance Contract. I like to use Index Universal Life, where you take the least amount of death benefit the IRS will let you get away with, because you're designing it for living benefits to use during your lifetime in retirement for tax-free income. And you're trying to put the most money the IRS allows as fast as the IRS allows, and it turns into a tax-free cash cow. This is where not only I have been able to earn rates of return averaging between 7 to 10% conservatively for more than 40 years, but especially since 1997 using Indexed Universal Life, I have earned net internal rates of return of 7, 10%, sometimes 16%, 25%, 30%, 61.33% and higher by using Indexed Universal Life. There are naysayers out there that go, I've never seen one do that. Watch my other episodes and you'll see actual statements of people who are being credited and earning 25, 30, 61% right now on their Indexed Universal Life policies. How their policies grow from $850,000 to $1,370,000 in one single year. Totally tax-free using this green bucket. So with the laser fund, I want to gift you a copy of my most recent best-selling book to help you understand this even better. But this is what I would normally do for many people that would come to me at retirement. I would say you ought to consider a strategic rollout. Now, this is not a rollover. A rollover is like going from the frying pan into the fire. See, a rollover is like taking money in a 401k and rolling it over to an IRA. And most people get duped into postponing and delaying that until they're age 72, and then they have to start taking money out of their IRAs or 401ks, or else what happens? There's a 50% penalty by the IRS on top of the tax. If you turn 72 and your life expectancy, let's say, is 20 years to make it simple, and you have $1 million nest egg in IRAs and 401ks, you must pull out 1/20th that year, or 50 grand, and be subject to tax. If you don't, the IRS will penalize you $25,000, 50% of the 50, on top of the tax. They want that money out in tax before you die so they can tax you again when you do die. So this is the best savings bond the government ever came up with for themselves, are tax-deferred IRAs or 401ks. A strategic rollout is where you're getting the money rolled out of this purple bucket, and you're doing that strategically, usually over a 5-year period down here to the green bucket. Now, when you do that, you're doing it strategically to where you're getting money out of here. Maybe you have 500,000 in here and you want to roll out 100 grand a year over 5 years down here to the green bucket. You do that strategically so that you'll be grandfathered to have tax-free income the rest of your life. The point is, you're trying to get taxes over and done with sooner than later in today's lower tax bracket. See, your current tax bracket is likely the lowest bracket you will ever be in. The only people that are in lower tax brackets when they retire are those that didn't save very much, okay? And so you want to get the taxes over and done with, reposition that after-tax money into something that's going to be tax-free from now on. The reason why I like the laser fund is not only because it knocks the socks off of these other types of investments as far as how much you can put in, how you can access the money tax-free, but at the end of the day, when you die, anything left in the green bucket in a laser fund blossoms and increases in value and transfers tax-free. I'm 69 right now. If I died tomorrow in an accident, every million in my laser funds would blossom to about 2.5 million and transfer tax-free to my heirs. That reimburses many-fold what I would pay in tax by doing the strategic rollout. Now, if this is intriguing you, subscribe to this channel. But the point is this: I have had couples come to me and they thump themselves on the chest and they go, hey, Doug, we've saved several $1 million and we calculate that between Social Security or our defined benefit pension with being a school teacher for 30 years, we have $40,000 of guaranteed income here for my spouse and $160,000 out of our IRAs and 401ks. That's a total of $200,000 of income. And I would look at him and say, well, yeah, I see one problem. Well, what's that? It's all showing up on the front page of your 1040 tax return. You mean there's another way? I go, yeah. See, you're paying $54,000 a year in tax. Do the math. You're gonna pay through the nose. You're only netting $146,000 after tax to buy gas, groceries, prescriptions, and golf green fees. They say, well, I'm a red-blooded American. I wanna pay my fair share of tax. Well, yeah, but if I could show you how to redirect otherwise payable tax to causes you support, would you be interested? Yeah. And so they would come and meet, we'd do a strategic rollout. At the end of 5 years, actually 4 years and 1 day, we would get $120,000 of that $200,000 of income off of their 1040 tax return. Now the IRS knows they're receiving it, they know everything. But the bottom line is, they were only paying tax on $80,000. The other $120,000 is tax-free. The IRS knows it. It's not some loophole. They still have $200,000 of income, but they're only paying $21,000 in tax. We saved them how much? $32,400 a year in taxes. Over their life expectancy, that's nearly $1 million, $810,000 based upon their LE. Their net spendable income is $178,000. I've never met anybody, Republican or Democrat, this is not a political decision, that didn't opt to save unnecessary tax. That is a strategic rollout. That's how you diversify. You want to have 40 to 60% of your income be in the green bucket, what I call the laser fund, and diversify and only have 30% at the most in the purple bucket, IRAs and 401ks, or the real estate bucket, and maybe nothing in the guaranteed bucket but your Social Security. That is smart diversification. So here's how you can learn more. So I want to gift you a copy of my most recent 300-page best-selling book. It's called The Laser Fund. You can go to laserfund.com, laserfund.com, or just click on the link below. Contribute a nominal amount towards the shipping and handling. I'll cover the rest of that cost. I'll fire out a copy for you. You also can listen and learn, watch and learn with other options there. But this is actually 2 books in one. This side is about 200 pages, 14 chapters with all the charts and graphs and explanations. If you're more of a right brain learner, you learn by stories, you flip it over and you read the orange covered side. It is 100 pages, 12 chapters with 62 actual client stories. You will see these charts that I've been referring to in this book. So claim your free copy. Here is to your brighter future.